Yeah, thanks for having me. I think the last time I spoke on one of these webinars was in August, which was just a couple months after our listing in June on the AIM. So a lot has happened for us, a relatively young company growing quickly. So pleased to be able to share an update here. And I'm very conscious of time, so I'll try to get through it quickly and give an overview of what we're doing. But I do want to spend a bit of time. We've just announced last Friday our largest transaction to date, which more than doubled our deployed capital. So pretty exciting news. I won't be able to get to everything today, so I'd encourage people to check us out on Twitter and LinkedIn and the other platforms. Go to our website, sign up for the newsletter, and we'll also intend to host a company-hosted webinar here in the next sort of 2 to 3 weeks, where I can spend sort of a good hour going through our portfolio and in particular our most recent transaction, because it does take a little bit of time to get through. But to start things off, we're an AIM-listed company, listed just last June. We have seen rapid growth since that time. We provide investors exposure to the mining sector by acquiring royalties over mining properties. And this is, just in the short time we've been around, come into focus, particularly for investors, given all the sort of inflationary pressures that we see. Central banks have clearly turned on the printing presses. And so the best way to hedge against inflationary concerns is through real assets, and commodities are obviously a key part of that. So it's really come into focus here over the last sort of several months. Now, stepping back a bit, because I recognize not everybody listening to this may be a mining investor or have a whole lot of experience in the space, so I'll touch on it just briefly. Mining royalties are probably not dissimilar to royalties that you may have experience with elsewhere. They're music royalties, they're listed entities that acquire royalties in all sorts of industries, and similarly to say a music royalty, for example, where the artist gets paid for each copy that's sold. A mining royalty entitles the royalty holder, Trident in this case, is entitled to a percentage of revenue from the underlying asset. So with that conveys a few benefits, a few pretty key benefits, because when you're looking to get exposure to the mining sector, say you're an investor that says, yes, I'm concerned about all the currency that's being printed. I want to hedge my portfolio and increase my exposure to mining commodities, gold, iron ore, copper, all battery metals. That's a pretty natural segue, but the sort of typical path is to get exposure to mining equities. So you go out there, you pick a mining company that you like, you buy shares, and that's how you get your exposure. Now, I suppose that the key difference between a mining company and a mining royalty company is the fact that as a mining equity holder, effectively the money comes into the company, operating and other costs go out of the company, and hopefully at the end of that, at the bottom of the P&L, you're left with some profit, and that's the upside exposure to mining equity holders, and that's why people invest in mining equities. Now, as a royalty holder, you're getting a percentage of revenue, so you're just at that top line exposure. So the underlying operating costs, by and large, don't impact us unless the mine becomes uneconomic for a long period of time and then has to shut down. But outside of that, the mining royalties as an instrument are sort of insulated from those costs. So, but that said, you still get the upside from that equities enjoy. So if the mine becomes incredibly profitable, right? If they discover more ore and extend the life, or if the underlying commodity significantly improves in price, or they increase the throughput of the asset, all that is why you invest in mining equities. You want to see the assets outperform or the commodity outperform. Well, royalties, by getting a percentage of revenue, still enjoy those same benefits. However, you're doing so from a more risk mitigated perspective, because when the opposite occurs, if the asset underperforms or if the commodity price declines, whereas you see that profit margin tighten and potentially go negative for equity, well, as the royalty holder just sitting at the top line and getting exposure to revenue, you don't want to see it decline naturally, but you just experience that decline. You don't see the compressed sort of profit margin. So in that sense, it's almost a derivative-like instrument that gives you exposure to the upside, but this sort of risk mitigation to the downside. On top of that, it typically sits senior in the security structure. More often than not, when a royalty is put in place over an asset, it remains there in perpetuity in most jurisdictions. So even if the operator goes bankrupt, typically the royalty stays there forever. Usually the royalty is treated by the mining companies that pay it as an operating cost, so you get paid before even senior debt gets paid. So a lot of benefits convey with royalties as a financial instrument. And then you compound that with the fact that a royalty company can go out there and acquire a pool of these royalties. It's very difficult for a miner to take an asset from greenfield exploration into production, let alone do that multiple times such that they're broadly diversified. Whereas a mining royalty company, we started with one royalty just last June, and last week we announced our 12th royalty acquisition. So it's because you're acquiring financial instruments, you're not buying mining properties and operating them. It is a very scalable business, and with that diversification, you see this outperformance. Both the benefits of the royalty instruments on a standalone basis, as well as the ability to diversify. On this slide, we're showing three of the larger peers in the space relative to the mining gold miners ETF, because these are gold-focused royalty companies. And clearly over the last 10 years or 10 plus years have outperformed. That said, I'd encourage you to look at any peers in the space. It's almost uniform in that they outperform mining equities. So then the next natural question we tend to get is, that all sounds very good. Mining royalties sound like the great way to get exposure to the sector. But well, then what is Trident doing differently? Because there are quite a few mining royalty companies in existence. And this slide really does sort of sum it up for us. The top pie chart that you can see there effectively shows the mining sector by revenue using 2019. You can use whatever metric you like or whatever year you like. It's broadly the same, or roughly the same, where it's about a third precious metals, a third base metals, which is nickel, zinc, copper, and a third bulk commodities and battery metals and industrials, and sort of everything else. And so that's the breakdown of the global sector as a whole. And yet, when you look at the breakdown below that of the mining royalty sector, very, very heavy precious metals focus and very heavy focus on the Americas. In fact, nearly all of our peers are their primary exchange listed in Toronto. And so it's unsurprising then when you map out their assets, very, very heavy weighting towards the Americas. And the genesis of royalties really in the mining space was in North America, and it was to finance precious metals mines. So despite the fact that there are opportunities all over the world, it's a sector that has been described as being in its adolescence, in the sense that just a few years ago, about 10 years ago, there were just a handful of mining royalty companies, sort of 3 or 4. And now there's sort of 20 plus listed mining royalty companies. So it has proliferated over the last sort of decade. In fact, you'd be hard pressed to find a mining company CFO that's evaluating their funding options and sort of looking at debt and equity and not considering a royalty. It's very much an established part of the landscape these days. That said, everybody, almost all of our peers are precious metals focused. You do have a couple that are sort of single assets, so effectively tend to be passive royalty companies that have one large single royalty. And then you've got a handful that are anything but precious metals. And then what's completely lacking from the space is an offering that's providing investors with the exposure in the graph above, which is a broadly diversified, almost index fund-like exposure to the sector, such that if an investor says, I want exposure to the mining sector, I want to increase my exposure, I'm concerned about inflation or whatever the case may be, I'm bullish on metals and mining, and I like the royalty model as a means to get my exposure, well, you couldn't even today cobble together a representative holding of the sector from the various royalty companies. It would be very difficult to do so. So what we're doing at Trident, what we've started to do is to build out that representative, diversified exposure. So I'll get into that in a second in terms of what royalties we actually have. The last sort of snippet on the royalty model in general, really from there, we're not doing anything different from our precious peers in terms of you acquire one royalty, you add another and then another and another. And as you grow your asset base and you're starting to get revenue from various sources, it becomes a business model that's very easy to get debt against. As you can imagine, a bank or a debt provider looking at providing debt to a junior miner that has 1 or 2 operations versus providing debt to a royalty company that has, say, a dozen royalties and several of which are in different commodities and different jurisdictions that are paying. that's a much lower risk profile. So you can get debt, and as you continue to grow, that debt gets less and less expensive, and you can grow the scale. You can also, there's a huge pool of existing royalties, so these can be acquired using equity. You'll find that parties that have existing royalties, typically as a non-core asset, are sort of happy to retain exposure to their asset, but swapping out that sort of single asset exposure by trading it into a royalty company, taking equity in exchange. They're swapping out a single asset and getting exposure to a portfolio, and recognizing that the royalty is going to get better value sitting in a royalty company. And so there's a lot of ways to sort of grow and scale this business, and that's been done sort of a dozen times over. And the ultimate objective for us is to get to the point where we're letting a chunk of that cash flow through directly to investors. So to get to the level where we can comfortably service debt, we can still go out there and acquire new royalties, but also service that dividend on a sustainable basis. And we're making good progress in that regard. And another element that's worth mentioning is you can see here junior royalty companies relative to minors stepping up to mid-tiers and then stepping up to majors. So with each transaction that you do, as you're broadening your asset base, well, the fact that it unlocks things like lower cost leverage and the ability to pay a dividend and those sort of initiatives results in the royalty companies getting an uplift in their valuation. So what you see is with each transaction you do, not only is that transaction on a standalone basis accretive and adds net asset value per share. So, at the end of each deal, each share of Trident has more value than it did before. But on top of that, you're getting the whole portfolio re-rating. So you get this sort of second kicker with regards to value accretion when you're building out the portfolio. And as mentioned, this has been done many times over in the precious space. And we're doing it from a broadly diversified perspective. That said, you can see some of our more recent sort of precious peers on this slide. The x-axis is day since inception of their royalty strategy, and we're the yellow line, so we're still relatively early days. But what you see is, as you add each royalty to the portfolio, the share price reflects that. It's sort of steadily growing. And then what the real sort of uplift comes down the track when you are able to unlock some of these initiatives, like paying a dividend or doing a dual listing if it's accretive, and then tapping into that lower cost leverage. And then you see this inflection point where the share price sort of takes off and the business model becomes truly self-sustainable at that stage from the revenue of the underlying assets in the royalty portfolio. So we are early days in that process. We've only been listed for less than 10 months. That said, we started with one paying iron ore royalty, and as I said, last Friday we announced our 12th royalty, and don't intend to slow down at all. Yet we're seeing what we need to see in terms of the markets paying attention. The share price is up over 80% since we IPO'd less than 10 months ago. So we're very bullish on the opportunity set in front of us. And conscious of time, I do want to get to the transaction that we did last week, because it is a transformational asset for us. Last little bit on our current royalty portfolio, you can see we were effectively hitting that a third allocation with regards to commodity. We don't obsess about that because we are a young company and we're growing quickly. So, we're just targeting the most accretive deals available to us. That said, we were getting a good diversified exposure into our portfolio. This new transaction is our biggest by far and puts us overweight into lithium, which I'll speak about in a moment. That said, I would flag that Coolinavi, which is now 10% of our deployed capital to date, at the time of our IPO less than 10 months ago, was 100% of this pie chart. So I think the speed at which we're diversifying and growing our scale, we're going to quickly get to the point where we aren't overweight. And with each transaction, you're naturally going to get sort of overweight in one sector or another. So there's a natural sort of progression here. The final bit before I jump into the new royalty acquisition is obviously diversification of commodity is an important consideration, as is diversification of the geographic exposure of the portfolio. So you can see in addition to being exposed to gold and copper and battery metals, we also and iron ore, we're also exposed to assets everywhere from Australia to Africa to South America to North America. And that's an important consideration as well. In fact, our last two transactions added North and South America to the portfolio, and in pretty key mining jurisdictions, which is an important consideration when you're looking to diversify and de-risk your portfolio. So just very quickly, if you want to learn more about our existing portfolio, jump on our website. There's a ton of information. There's other interviews under the media. I do just want to spend the last few minutes on Thacker Pass because this was a massive transaction for us. Just real briefly on lithium. For those that aren't familiar, lithium is a pretty critical, not pretty, it is sort of a significant battery metal in that, we heard one of the speakers earlier talking about the opportunities in the rechargeable battery sector. As we see EVs uptake increasing, lithium is a critical component of every single battery chemistry out there. There's various battery chemistries and sort of next generation vehicles that will be shifting and changing, and basically as far out as we can see today, lithium is a critical component of all these chemistries, and that's an important thing because some other mining commodities, you can find that they're expensive, they are coming from politically unstable jurisdictions, and they're going to be engineered out over time. Lithium, the cost of lithium does not drive the cost of the battery, so you see that it's pretty consistent throughout. And what that means is getting exposure to a world-class lithium asset by having a royalty over that project means that that you get exposure to that battery thematic from the best sort of financial instrument, in our opinion, the best sort of financial instrument that you can get exposure to a mining asset. And then we think one of the best commodities for a once-in-a-generation shift. These sorts of opportunities don't arrive very often. So we were thrilled to get this asset. Effectively, it was a royalty that was held by a third party, not the operator of the asset. This royalty was written back in 2013 when the asset was sort of exploration stage, so it helped fund their exploration. In exchange, the provider of capital received the royalty. Now, they're a fund that has a fixed life and invests in mining space. They have to monetize this asset. They can't hold it forever. So they're happy to sell down 68% of it to us. In terms of economics, it's an 8% royalty, so you get 8% of the revenue derived from that asset. That said, the operator has the right to buy it down to a 1.75% royalty by making a one-off $22 million payment. As you can imagine, the economics are pretty compelling to do so, and all their study work assumes that they will in the first year of operation. So the way we look at it is we'll get 60% of that 1.75, so we'll have just over a 1% gross revenue royalty over this project. It's uncapped, it's there for life of mine, which is a 46-year mine life. So in terms of getting exposure to that rechargeable battery and EV thematic, this is the kind of asset that you're looking for. And it's a half century nearly of reserve life, and then the resource is twice the size of the reserve. So there's potential to expand production along the way. There's very good potential to extend its life. It could very easily be a century life sort of mine. So it's a truly world-class, enormous asset. In terms of economics, with the operator buying back a portion of the royalty, it would see 13 million come back to Trident. So we spent 28 million to acquire the royalty. We'd expect to get 13.2 million back from that buyback. And then from there, based purely on their most recent technical studies, we would expect the royalty to pay about 3.8 million at their phase one, and stepping up to 7.6 million on phase two. Now that's subject to change as they finalize their studies and as commodity prices change, but as a guiding light, that's sort of how we're viewing the world. So you can do the back of the envelope calculations, or I can do them for you. Internally, our base case is sort of a mid to upper teens post-tax IRR. So to get that sort of return year after year for 46 years, pretty compelling financial case. You can see here the revenue profile. The dark blue is sort of our existing portfolio based on broker estimates, and then purely based on the pre-feasibility study, this is the sort of revenue profile we'd expect to see from Thacker Pass. And I should say, when I'm quoting those IRR return numbers, that's our internal estimates, which are more conservative than the PFS, which we're showing here. So we slightly haircut ramp up and those sorts of things. But kind of two things that I guess we really want to get across is, for us, as I said, we're charging towards wanting to be able to provide investors with a dividend. And even if we were to sit on our hands today, this kind of revenue profile, because the asset has been materially de-risked in that the operator of the asset got their final key permit in January, and then off the back of that raised $400 million US almost entirely allocated towards commencing construction of this asset, which is intended to commence at the end of this year, early next year. So it's got a very clear pathway to production, which is obviously a key consideration because you can buy royalties over assets at various stages in their life, in production all the way down to pre-resource. So the fact that this one is an enormous resource and has a very clear pathway to when it's going to be in production, it's a pretty compelling economic case to then be able to see the step up in revenue that it provides to Trident to allow us to unlock that dividend. If we were to sit on our hands and not add any more royalties between now and then, this is the kind of asset that would get us across the threshold we need to start initiating that dividend. And clearly, given this is our 7th transaction since listing less than 10 months ago, we won't be sitting on our hands, I can assure you. But you can see what it does for us sort of qualitatively. And then the other, I suppose, qualitative factor on top of the returns and everything else associated with the royalty is we did a fundraise alongside this. It was many times oversubscribed. We were very pleased to get some real high quality institutions on the register. And by doing so, that built out our market cap, and we're now closing in on the sort of 100 mil US market cap. So with that, you open up to new pools of capital that have sort of minimum thresholds with regards to investing criteria. It improves liquidity. It allows people to get in and out of the stock as they need to and want to. So I think not only was this a transformative transaction for us in providing exposure to a key battery metal from a long life tier 1 asset in a tier 1 jurisdiction, but also for Trident more broadly, it did quite a bit with regards to expected revenue profile and some of the supportive institutional shareholders we got on the register and what it can do for our liquidity. So we're over the moon. I could clearly talk for another hour about this particular asset because it's not often that you can find an asset of this quality and caliber. And I think in one of the most exciting spaces within the mining landscape. So, but with that, I will turn it over to questions. And as I said, we'll hopefully be out there in the space talking a bit more about this asset in the very near future.
Super. Adam, thank you very much indeed. Most of the questions we've had come in have been around dividends and when they might be starting and what kind of coverage and so on. I think you might have kind of covered that mostly just in your summary there. But if anyone at home wants any clarification on that, just quickly send us a message and we'll try and ask Adam to go over it again if needed. So moving on, are royalty deals getting very expensive or more expensive now that commodity prices are on the up?
Yeah, it's a good question. I suppose that's one of the benefits of being diversified because most of our peers, as I said, are precious metals focused. So they've kind of got a gun to their head. They either have to do, precious metals can go for a run. They either have to do deals and see tight return profiles, or they sit back and just don't do deals, which isn't an attractive prospect for a public company. We've got the nimbleness where we can, when we listed it was with an iron ore asset, then we did a copper transaction, then we did three gold focused transactions before pivoting back to copper and now battery metals. So we've got a bit of nimbleness built into our business model. And then with regards to are they getting more expensive, what we've found is that there's royalties that you can write to provide capital to the actual miner for them to advance their project. And then there is a whole pool of existing royalties that you can go out there and buy from third parties and consolidate into a royalty company. What we found is some of those sellers of royalties want to see the uplift in commodity prices that we've seen over the last few months reflected immediately in the price that they're willing to accept in the royalties. That said, for primary royalties, I think that market is opening up because the miner's objective is to expand their projects or build their projects or advance them. So they want to get the capital in the door, and they're less obsessed with trying to capture the sort of quick uplift in mining commodity prices. So again, it comes back to the nimbleness. I think you pivot to other commodities within the sector. You pivot from secondary to primary, but we found that it hasn't constrained our pipeline at all. And then couple that with the fact that as we're getting larger and doing more deals, well, people just know who we are now. So we're getting more and more transactions sent our way. So our pipeline's never been more full.
Leads very nicely to the next question. What are the key target commodities for future royalty streams? Is it rare earth metals?
We are looking at, there's quite a few, to be honest. We flagged in the most recent update on our pipeline 12 active NDAs. I'd say that it was by and large very heavily focused on battery metals and base metals in particular. We're always looking at the odd sort of precious metals deal, but we're particularly choosy because those can get get expensive given there's more competition. So we sort of focus on precious metals in geographies that are sort of out of focus for most of our peers listed in North America. So yeah, I'd say probably expect more in the base metals, base and battery metal space. That's sort of taking up the bulk of our time at the moment.
Next question is, you mentioned recent fundraising. Did management and board take part in financing? And then other people have made a comment about the primary bid, people being scaled back, and any in the future greater allocation for retail participation.
Yeah, so first question, yes, management and the board did participate. We were I flagged that we were excited with the outcome of the fundraise. We did it effectively at no discount. And as I said, we're oversubscribed, so that was a great position to be in. On the primary bid, to be honest, that was obviously our first time having done that. Our objective was to make sure that the retail shareholders who've been supporting us all along since our listing get the opportunity to invest alongside the largest institutional shareholders. That said, we didn't have a great expectation on just how much uptake there would be. So, the way it functions was there's a 4-hour window, and we had just over £500,000 with which people could participate. And to be perfectly honest, we expected sort of maybe half of that to be taken up. But what we found was after 2 hours, we were almost 4 times oversubscribed. So we closed it off. So I think we're now sort of aware of the appetite out there, and at the next time around, we'll certainly take that into consideration.
A question from a kind of different tack. Why would a mining operator take an investment from Trident, or I guess to do a transaction with Trident, rather than a traditional lending facility?
Yeah, that's a great question. One we get all the time. And so I should flag most of the royalties we've acquired are from the secondary market from existing royalties. A lot of them generated from M&A and past JV agreements. Then you're a miner that's ended up with this legacy royalty from a project they used to own. That said, we have done primary financing, and the reason it varies. I think a couple reasons. The other options are to do equity, and I challenge you to go out there and find a mining company CFO that thinks their stock is fully valued and is happy to raise at that price. So they always think they're woefully undervalued, and so a non-dilutive mining royalty preserving their share value, that has some certain appeal. And then relative to debt, well, it's just covenant light. They pay us when they're generating revenue. If they cease generating revenue, or if they're pre-revenue, then a royalty may make sense because that they put it in place, but there's no covenants. They don't have to maintain ratios. So it's got a pretty solid niche where it just makes sense. And typically, what you see is a conjunction, particularly for project financing, a mix of equity, debt, and a royalty or stream. To comprise a sort of good balance on how they're looking at their capital structure.
Okay, and we are a little bit we're a little bit over time, but I think it's all right if we have one more. The question is about what stage of mine development do you do a deal? So if you're dealing with the primary issuer, the counterparty, the mining company themselves, at what stage in the mine development do you seek to have a transaction through the kind of the mine development? Whereabouts would they be?
Yeah, so we do flag that we target production or sort of pre-production or near production. Now that said, it's important to have the sort of full breadth. We've got everything from pretty early stage exploration, obviously, to having acquired royalties on producing assets, because we are generating revenue from 2 royalties. We've got a third that's in construction now, albeit our royalties not over the entire project, but and then a fourth that's sort of moving pretty steadily in the right direction. And then clearly with the addition of Thacker Pass. In fact, Thacker is probably a really good example of what we look for. I mean, great if you can go out there and get a royalty that's producing and get it at a good price, which is the critical thing. But an asset like Thacker Pass, when you see it cross the sort of the really permitting and financing of the project are the 2 key hurdles you need to see for an asset to go from being just one of many development stage mining projects to one that now has a pretty clear pathway to being in production in the near term. So once they got their sort of key federal permit and raise that equity financing to go out there and build the mine, that's when you can look at a project and say, yeah, we can take comfort. It's been materially de-risked. Yes, it's not in production yet, but things would have to go sort of materially sideways for it not to get to that stage. And again, as a royalty holder, part of the benefit is you can sit back, your royalties over the project. if they have CapEx overruns and all that, as an equity holder, you're scared about that because they have to go out there and raise more money to finish the project. But as a royalty holder, you applaud that because the more money pouring into the project, the better. You just sit back and clip your ticket every time they generate revenue. So it's a fantastic business model from that perspective. And yeah, but that is the type of asset that we really are trying to zero in on.